Okay, so here is a wild one for you. A company famous for building solar panels that physically pivot to follow the sun is suddenly pitching itself as the ultimate power backup for AI data centers. Welcome to Earnings Unscripted. Today is May 12th, 2026, and we're diving into Nextpower's fourth quarter results. That is ticker NXT. And I mean, it is a truly fascinating report. They posted a massive EPS beat. The backlog just crossed $5.25 billion. But, well, under the hood, the numbers look slightly contradictory.
Yeah, contradictory is probably the polite word. Look, the market clearly loves the headline. The stock was already on a very strong run this quarter, and then it spiked double digits in the extended session. It sort of flattened out just under $140 ahead of the call. But you read the actual top line, and it feels like, well, a bit of an optical illusion.
Okay, before we completely ruin the illusion, a very quick reminder that everything we talk about here is just our personal opinion, not financial advice. So please, no lawsuits. But seriously, an illusion? Because revenue dropped this quarter, right?
It did. Revenue came in at $880.5 million, so that is down 3% sequentially from Q3. And operating income took an even bigger hit, dropping 13% to $153.5 million. But here's the magic trick. Net income jumped 15%.
Wait, operations made less money, but the bottom line went up 15%?
Exactly, pushing diluted EPS to 97 cents a share, up from 85 cents last quarter, easily beating expectations.
Okay, but how does that math actually work?
Taxes, mostly taxes. They had a massively uncharacteristically low tax provision in Q4, just $9 million, down from almost $50 million last quarter. So that huge EPS beat was essentially carried by a $32 million tax adjustment.
Wow. That feels like a pretty heavy lift for a single accounting line.
It is, and the top-line revenue drop is also a bit of smoke and mirrors. Management noted they stopped consolidating their Middle East joint venture this quarter, which shaved roughly 300 basis points off the reported revenue, organically.
It feels like we spend half our lives untangling accounting quirks, but to be fair, they are doing real work on the core business side. Gross margin actually expanded. It hit 33.8%, up over 200 basis points, and they did that through some pretty aggressive tariff recoveries with customers.
Right, which they kind of have to do given the global freight nightmare right now. Red Sea drone disruptions are jacking up logistics costs everywhere.
Yeah, exactly. The core solar tracker business is really holding the line. And CEO Dan Shugar had this great anecdote on the call about sitting on a beach in Hawaii, watching local oil infrastructure, and realizing that high global fossil fuel prices basically make their solar pitch invincible right now.
The macro tailwind is huge, for sure. But they're definitely not just sitting back and relying on tracker growth. They have zero debt. They are hoarding cash, and now they're dropping $130 million to acquire power conversion tech. They actively want to replace gas peaker plants for AI data centers.
Which is an incredible story to tell Wall Street. But that comes with a bill, right? You do not just step into massive utility grid tech for free.
Definitely not. And that is the tension point here. Management is already warning that operating expenses will balloon next year. To fund this rollout, CapEx is basically forecasted to triple to fund U.S. manufacturing lines.
All right, let's get into the details on that because the cash flow shift required for this pivot is absolutely wild.
It is wild. You look at their free cash flow, and they pulled in $154 million this quarter alone. That gives them over $1 billion in total cash, zero debt. But they are about to burn a serious chunk of that pristine balance sheet.
Right, because of this non-tracker expansion, the $130 million power conversion M&A, which, okay, data centers are hungry for energy, we get that. But why are they buying central inverter tech instead of just, plugging solar panels into the existing grid?
Because the existing grid relies on natural gas peaker plants, and gas plants take too long to turn on. Look, CEO Dan Shugar had a great way of phrasing this on the call. He said gas reacts in seconds or minutes, but AI data centers measure power stability in milliseconds.
Ah, I see. Wait, let me guess. It is the EV versus combustion engine metaphor he used.
Yeah, exactly that. He challenged people to think about the immediate acceleration of an electric vehicle compared to an internal combustion car. A gas peaker plant simply cannot catch a collapsing microgrid fast enough. A battery connected to their new power conversion tech can. So they are effectively trying to replace fossil fuel backups entirely.
That is actually a brilliant pitch. It takes them from just being a commodity solar hardware vendor to a critical infrastructure provider for the hottest sector in the market. But it completely destroys their near-term operating leverage.
Yeah, it really does. That is the cost of pivoting. Chuck Boynton, the CFO, flat out warned that operating expenses are going to balloon. They're modeling OPEX at roughly 10.5% to 11.5% of revenue for fiscal 2027. And CapEx is the real shocker.
You love a good CapEx shocker. What are we looking at?
It is skyrocketing. They're forecasting $75 to $100 million for the year. Just to put that in perspective, they only spent $44.8 million in all of fiscal 2026. They are tripling capital expenditures to build out U.S. manufacturing lines for these new inverter products and to roll out a new ERP system.
Wow. So they are basically rebuilding their whole operational engine mid-flight, which, I mean, is a bold move. But it feels incredibly risky if their core tracker business starts to soften. And actually, this brings up something else in the filings, the tax credits.
The IRA 45X vendor rebates.
Right. So despite them having this near-record bookings quarter and a backlog over $5 billion, their recognized 45X tax credits actually fell. It dropped to $47 million, down from $53 last quarter. And wait, it was $67 million the same time last year. What is choking the yield there?
That is the multi-million-dollar question right there. Look, it could be compliance issues with foreign entity of concern rules, or maybe domestic module production is quietly scaling back. But the implication is clear. If those U.S. manufacturing subsidies keep eroding, their gross margin relies entirely on pricing power and volume.
And they're already passing tariff costs on to customers to protect those margins, treating customers like partners, as Boynton said on the call. But in this tariff environment, there is only so much goodwill you can extract before buyers push back.
Sure, but the guide is doing a lot of work there. President Howard Wenger pointed out that customers actually want this. They're increasingly looking for integrated solutions to simplify project procurement. If Nextpower can bundle the tracker, the software, and the battery inverter into one sale, the customer might tolerate a higher price because it reduces their overall system risk.
Okay, yes, but that cash flow line still matters more. It feels almost like they know the legacy business has a ceiling, and they're using this incredible war chest to buy their way into the AI economy before the door shuts.
No, but that is exactly the issue. They're funding their own metamorphosis, and it's going to be expensive. They even announced a $500 million buyback. But honestly, given this CapEx jump, I wonder how quickly they actually deploy that capital.
So balancing all of that, a massive M&A gamble, shrinking tax credits, but obviously incredible market demand. So where does this leave their actual trajectory heading into next quarter?
Well, it is basically a message of absolute confidence. They are officially telling the street to buckle up. Management actually raised the targets they set at their capital markets day just 6 months ago. They are now projecting fiscal 2027 revenue between $3.8 and $4.1 billion, with adjusted EBITDA hitting up to $900 million.
Which is a huge vote of confidence. I mean, they are essentially saying, yes, this transformation is expensive, but it pays off immediately.
Right, except margins are the real story here. For Q1, they are guiding for low single-digit revenue growth sequentially, with gross margins resting in the low 30s. If they can maintain that 30-something margin while digesting a $130 million acquisition, I will genuinely be impressed. It shows actual discipline.
Coming from you, that is basically a standing ovation.
Let us call it polite nodding.
But look, the most telling number is their target for the new products. They expect the non-tracker business to grow over 40% next year, pushing it to roughly 15% of total revenue.
That is not an experiment anymore. That is a completely new corporate identity.
Exactly. The solar hardware company is aggressively reshaping itself into an AI data center backbone, which, is either genius foresight or peak cycle hubris. I guess we'll find out next year.
Or next quarter, depending on how fast that cash actually burns.
Fair point. Well, whatever happens, they definitely made solar infrastructure interesting again, so I guess we'll leave it there. Thanks for bringing the numbers today, Mito.
Always a pleasure. Talk to you after the next print. If you want these conversations to just magically appear in your player, go ahead and follow the podcast. This is a fun project where we use a little AI to help us parse those massive 100-page SEC filings so we can focus on pulling out the human story. And we would love to hear what companies you want us to dig into next. If you send a quick note to earningsunscripted@datamadness.ca, or you can just use the X link in the show notes.
See you next time.